Welcome to this audio overview, your ultimate A-star playbook. Today, we are absolutely tearing down and rebuilding everything you thought you knew about IGCSE Accounting 0452. Specifically, we're zooming in on processing data in ledger accounts. Now, think about modern AI-driven accounting software, platforms like Xero, that process thousands of complex entries in literal milliseconds. Well, here's the secret. Those cutting-edge platforms are built entirely on the foundational architecture that we are mastering right here, right now. This isn't just about basic record-keeping, guys. This is the bridge between simple data entry and high-level financial intelligence. So let's get into it.
Here's our roadmap for this explainer. We've got 4 main stops: core concepts and vocabulary, technical execution and method marks, evaluating financial health, and finally, those critical examiner warnings you absolutely need to know.
Okay, moving right into Section 1, Core Concepts and Vocabulary. Think of this as your modern blueprint.
Right, so putting on my examiner hat for a second, I need you to hear this loud and clear. Cambridge has made a very strict transition to modern international terminology for the syllabus 28 to 2030 updates. If you are still using outdated textbook terms, you are literally throwing away easy marks. You must use irrecoverable debts instead of bad debts. It's owner's equity now, not capital. As an examiner, I'm telling you, we actively look for this exact updated vocabulary. It's an instant signal that separates the true A-star candidates from the rest of the pack.
And that brings us to the absolute bedrock of the whole system. Assets equals liabilities plus equity. This equation is the architectural blueprint of the business entity concept. You have to understand the duality of every single transaction. It's like a balancing act. If you buy a shiny new delivery van with a bank loan, sure, your assets go up, but so do your liabilities. Maintaining this fundamental equation throughout the fiscal period is exactly what keeps the entire financial structure from just collapsing in on itself.
Speaking of structure, we really have to talk about the prudence concept. Prudence is the guiding principle of never, ever overstating your profits and definitely never ignoring your potential losses. Think of it as your ultimate safeguard against artificial financial inflation. If a business just decides to ignore a potential loss, well, they're painting a completely fake, overly optimistic picture of their health. And doing that, it completely destroys the integrity of the ledger.
You'll also need to be highly fluent in terms like realization, accrued, and prepaid. Why? Because mastering this specific vocabulary ensures you can untangle really complex, multi-layered business scenarios. It's absolutely vital for documenting your evidence for those AO3 investigative and practical skills. Remember, interested parties, we're talking banks, tax authorities, investors, they rely entirely on the integrity of your records. Bottom line, if your vocabulary is muddy, your ledgers are muddy.
All right, let's roll up our sleeves. Section 2, Technical Execution and Method Marks. This is what I like to call the trench work.
So, how do we completely eliminate calculation errors? With strict, step-by-step procedural logic. The chain always begins with identifying the correct source document, like an invoice or a bank statement. That document then feeds directly into your books of prime entry. From there, the data flows neatly into the T account, and finally, it lands in the trial balance. Understanding this exact cause and effect chain is a total game changer. It turns data processing into a highly logical sequence, not just a stressful memory game.
Let's zoom in on that T-account structure for a second. The most vital mechanical skill here is distinguishing between balance B/D and balance C/D. Under intense exam pressure, minds go blank, right? So use this simple memory hack. B in brought down means it begins the new period. C in carried down means it closes the current one. Getting these backwards totally destroys the chronological flow of your accounts. So lock that mnemonic into your mind right now. B for begins, C for closes.
Now, this might be the most important thing I say today. In your exams, method marks are awarded even if your final balance is completely 100% incorrect, provided your logical flow is visible to the examiner. Let me repeat that for impact. Show all your workings. We call this the advanced technical methodology. Especially with those tricky, complex adjustments, if you make a tiny math mistake early on, but you logically process that incorrect number through the rest of the accounts, guess what? You will still capture those crucial method marks.
Of course, aiming for perfection means dodging some really common mathematical pitfalls. 2 massive traps we see constantly: miscalculating the percentages between trade and cash discounts and totally forgetting state symbols in manufacturing accounts. Remember the golden rule here. Trade discounts happen before the invoice is even written. Cash discounts happen much later at the actual point of payment.
Keep those two entirely separate in your procedural logic, and you'll navigate safely past the trap. Moving on to Section 3, Evaluating Financial Health. Let's step back and take the executive view.
Listen, calculating a ratio is just a baseline skill. Honestly, a calculator can do that. But identifying what that ratio actually means for a business's real-world liquidity, now that is what defines an A-star candidate. Imagine you're a financial detective. You see a current ratio that has suddenly plummeted from a very healthy 2.5 to 1 all the way down to a highly concerning 1.1 to 1. So what does that actually tell you?
Well, you can't just state that liquidity dropped. The examiner already knows that. You have to diagnose the root causes. Did the business overpurchase inventory, suddenly tying up all their free cash and stock sitting in a warehouse? Are trade payables being settled way too slowly, which is probably angering suppliers? Or maybe cash reserves were intentionally depleted by a massive capital expenditure, like buying a new factory. Diagnosing these specific root causes is the absolute essence of high-level AO3 evaluation. And this level of analytical thinking has to extend to inter-firm comparisons too. If you are comparing two rival competitors, look really closely at their underlying accounting policies. Firm A might use straight-line depreciation, while Firm B uses the reducing balance method. Because of that, a direct face-value comparison is literally impossible. You have to look way beyond the surface numbers to analyze the true underlying quality of their reported profit.
To take it a step further, true financial intelligence means looking completely beyond the ledger itself. You absolutely must evaluate non-financial factors, things like staff morale, the geographic location of the store, and overall market reputation. These things are totally invisible in the strict accounting records, yet they are incredibly vital for long-term sustainability and evaluating the ultimate return on capital employed, or ROCE. You must always bring this broader context into your AO3 evaluations.
All right, we are in the home stretch. Section 4, Critical Examiner Warnings. Consider this your insider's edge. Here is a critical, major warning straight from the marking rooms, failing to perfectly distinguish between revenue items and capital items. This is a classic trick area. Capital expenditure buys or improves a non-current asset, right? But revenue expenditure simply maintains it. If you accidentally categorize a major, permanent machinery upgrade as just a regular revenue expense, you distort the asset values on the balance sheet and you simultaneously distort the profit. Examiners actively hunt for this exact dual impact error, so don't fall for it. Now here's a strictly practical and frankly completely preventable piece of exam strategy directly from the principal examiner insights. Students often lose marks through poor handwriting in ledger accounts. I know, it sounds almost too basic, but the reality is devastating. If an examiner literally cannot read your numbers, they simply cannot award you those vital method marks we talked about. Crystal clear handwriting, precise documentation, and strict time management are honestly just as important as knowing your accounting theory.
As we wrap up this masterclass, I want to leave you with a pause and think A-star challenge. If you are reviewing a complex ledger and you notice the current ratio has absolutely plunged, ask yourself, did the accountant violate the prudence concept by hiding potential losses? Or did the business simply and safely deplete their cash through a highly planned capital expenditure? Connect the mechanical trench work with the high-level executive view. Master that cause and effect chain, and you are entirely ready to conquer paper 2. Keep practicing, and I'll see you next time.